Another California-based bank is facing a crisis, and the situation looks dire. Shares of Silicon Valley Bank plummeted by a staggering 60% today, and continued to drop by another 28% after hours. This means that in just 24 hours, the bank stock has fallen by over 70%. And it's not just Silicon Valley Bank. Yesterday, another crypto-focused bank called Silvergate Capital announced that it was shutting down and liquidating. What on earth is going on with these big banks in California, and could this be a sign of a bigger issue? One key player in the venture capital space, Founders Fund, seems to think so. In fact, they're advising their own portfolio companies to withdraw their funds from Silicon Valley Bank. This is a worrying sign, and it's causing concern among investors and clients alike. The CEO of Silicon Valley Bank is doing his best to reassure everyone that everything is fine, but when a bank run starts, things can quickly spiral out of control. So what does this all mean for the future of banking, and for the world of crypto in particular? It's hard to say for sure, but one thing is certain: we're living in an era of rapid change and disruption. The traditional banking system is under pressure from all sides, and new players are emerging all the time. In times like these, it's more important than ever to stay informed and be prepared for whatever the future may bring. Hello and welcome back to our channel. Today, we want to talk about a developing crisis in the banking sector that could have far-reaching consequences. As you may have heard, California-based bank Silicon Valley Bank experienced a major drop in its share price on March 9th. Unfortunately for the bank, things don't look like they're going to get better anytime soon. One of the biggest players in the world of venture capital has advised all of their clients to withdraw their money from the bank, and this could trigger a bank run. A bank run is a situation where all of the clients of a bank try to withdraw their money at the same time. This can be disastrous for the bank, as they simply don't have enough cash on hand to make all of the payments. Silicon Valley Bank has a lot of its capital tied up in longer-term assets, which means that they could be in trouble if they're hit with a sudden wave of withdrawal requests. Unfortunately, this isn't an isolated incident. Just a few days ago, another US-based bank called Silvergate Capital went into liquidation after losing over $1 billion in the first quarter of 2022. This was due in large part to the withdrawal of over 50% of all deposits they were holding. These events are a stark reminder of the importance of trust in the banking system. When that trust is lost, bad things can happen. It's up to us as consumers and investors to stay informed and make wise decisions about where we put our money. Welcome back. In this video, we'll be taking a closer look at the events that led up to the recent troubles at Silicon Valley Bank, and whether or not this could be the start of a much larger crisis. Silicon Valley Bank was founded over 40 years ago, in 1983, by Bill Biggerstaff and Robert Medeiros. The bank was created to service the growing venture capital market in the United States, and to provide a specialist financial institution for holding large deposits received by small companies from venture capital investments. The idea was well received among the venture capital community, and in 1988, the bank completed an initial public offering on NASDAQ, raising $6 million. The business expanded across the entire country throughout the 1990s, and in 2001, it acquired Palo Alto investment banking firm Alliant Partners for $100 million. However, the bank's recent troubles have sparked concern about its future. As we mentioned earlier, one of the biggest players in the venture capital world has advised their clients to withdraw all of their money from the bank, potentially causing a run on the bank. The bank's shares have dropped by 60% in a single day, and it looks like there could be more trouble on the horizon. But this isn't an isolated incident. Just a few days ago, another California-based bank, Silvergate Capital, went into liquidation after losing over $1 billion in the first quarter of 2022. Are these just isolated incidents, or could this be the start of something much larger? Could this be a black swan event that triggers a new global financial crisis? These are important questions that we need to ask ourselves. So, as I understand it, the problems at Silicon Valley Bank began in 2021 when the bank saw a massive influx in deposits, which increased from around $62 billion at the end of 2019 to $189 billion at the end of 2021. While having too much cash might seem like a good thing, it can be a problem for banks because they need to make a return on that capital. In order to try to make a return on this capital, Silicon Valley Bank turned to the capital markets. However, due to the COVID-19 pandemic, interest rates dropped to their lowest levels in history, making it quite difficult for the bank to earn a meaningful yield. To address this, Silicon Valley Bank looked to the longer-term markets and purchased over $80 billion of mortgage-backed securities. The bank also reportedly invested in other securities, such as collateralized loan obligations, which are complex and risky financial instruments. These investments were apparently made without adequate risk controls, leading to significant losses for the bank. As a result of these losses, Silicon Valley Bank has faced increased scrutiny from regulators and investors, and many clients are reportedly looking to remove their funds from the bank. This has led to concerns that the bank may face a liquidity crisis, which could have wider implications for the financial system. It's worth noting that Silicon Valley Bank is not the only bank to have faced problems recently. In 2019, Silvergate Bank, another bank that specializes in serving the cryptocurrency industry, saw its stock price plummet after it reported significant losses on a single loan to a cryptocurrency firm. These events have led some analysts to question whether we could be seeing the early stages of a new global financial crisis, or whether these are just one-off events specific to these individual banks. Welcome to our video about Silicon Valley Bank and the problems they are facing due to their investments in long-term bonds with a low yield. This portfolio of bonds had an average yield of 1.56% and an average term of more than 10 years. The plan was to hold these assets until maturity. However, over the past 12 months, inflation has caused problems in most economies around the world, and central banks have increased interest rates to counter this. In the USA, interest rates have increased from 0.25 to 4.75%, causing a major problem for Silicon Valley Bank. Why is this increase in interest rates a problem? Well, interest rates have an inverse relationship to the price of bonds. When a bond is issued, the interest rate on that bond is fixed and appropriate to the current market conditions. So, if we look at the portfolio that Silicon Valley Bank has invested in as an example, the bank mortgage-backed securities have an average yield of 1.56%. For every $100 bond that the bank is holding, it will be paid $1.56 in interest every year. However, because the current rate of interest is 4.75%, if you were to buy a bond in the market today, you could get a yield of around 4.75%. To achieve the same annual interest of $1.56 that Silicon Valley Bank is receiving on its bonds, you would only need to buy around $32 worth of bonds in the current market. This is why there's an inverse relationship between interest rates and bond prices. When interest rates go up, bond prices go down, and that is the major problem for Silicon Valley Bank. They have invested over $80 billion of their customers' money into long-term bonds that have a yield of 1.56%, and the value of those bonds today is significantly below $80 billion. Over the long term, this wouldn't be a problem if Silicon Valley Bank could wait until all of these bonds matured. Then they would receive back the full $80 billion, as a bond is settled at par, and you receive back your $100 from the original $100 that you invested. However, if Silicon Valley Bank can't afford to wait for another 10 years for those bonds to mature and they have to sell them in the market, that's when they start incurring losses. Unfortunately, that's exactly what's happening at Silicon Valley Bank right now. Due to a large number of customers asking for their money to be returned, Silicon Valley Bank was forced to sell some of the bonds that they're holding. As a result, they've incurred huge losses. The bank has announced that they've sold 21 billion of their available for sale securities at a loss of $1.8 billion. As a result of this, the bank has announced that it needs to raise $2.25 billion in equity and debt. It's a tough situation for Silicon Valley Bank, but what does this mean for their customers? Will they lose their money? Will they get their money back? Silicon Valley Bank, one of the largest banks that specializes in providing services to tech startups, is reportedly facing some serious financial troubles. This has come as a shock to investors who believed that the bank had ample liquidity to avoid selling any of their available securities. Unfortunately, the bank's portfolio is now underwater with an average yield of 1.79 compared to the current 10-year Treasury yield of 3.9%. Even prominent venture capitalists such as Peter Thiel have asked their portfolio companies to move their funds away from the bank. Union Square Ventures and Foundry Group have also advised their portfolio companies to pull money, and another major VC firm told its portfolio companies to remove their cash on an as-needed basis. Gary Tan, the CEO of Y Combinator, warned startups that solvency risk is real and recommended they consider limiting their exposure to Silicon Valley Bank. Although over the long-term deposits are not likely to be at risk, the shorter term is harder to predict, according to Founders Fund. Venture firm Tribe Capital has also advised its portfolio companies to move some, if not all, of their balances from the bank. What's important to understand is that banks all have leverage, and they use deposits, so almost by definition, any bank with a business model is dead if everybody moves. Therefore, diversifying your risk is a better option. In light of these events, many companies have started moving their funds to other banks such as First Republic Bank. Meanwhile, in the world of cryptocurrency, Silvergate Bank has become a leader in providing corporate services to cryptocurrency businesses. Founded in California in 1988 as a traditional bank, Silvergate CEO Alan Lane invested in Bitcoin in 2013 and decided to start servicing cryptocurrency clients. The bank developed a strong niche in the market, attracting names such as Genesis, Gemini, Coinbase, and Kraken. Its flagship product, the Silvergate Exchange Network, allows all of its cryptocurrency clients to exchange cryptocurrency for US dollars round the clock, 24/7. Essentially, Silvergate acts as a real-world bridge between the cryptocurrency clients and the markets. The news that Silicon Valley Bank, SVB, is facing liquidity issues has sent shockwaves throughout the investment community. Many believe that SVB had enough liquidity to avoid selling any of their available-for-sale securities, but it appears the portfolio is seriously underwater, yielding an average of 1.79 compared to the current 10-year Treasury yield of 3.9%. This has prompted several venture capital firms, including Founders Fund, Union Square Ventures, and Tribe Capital, to advise their portfolio companies to move their funds away from SVB due to the solvency risk. Y Combinator President and CEO, Gary Tan, warned startups to limit their exposure to SVB, adding that solvency risk is real and that startups should consider diversifying their risk by not exposing themselves to more than $250,000 of exposure. Similarly, Active and Capital is helping some of its portfolio companies move their capital to other lenders and is urging CEOs to transfer their SVB balances to other banks. Meanwhile, Silvergate Bank, founded in 1988 as a traditional bank, has carved out a strong niche providing corporate services to cryptocurrency businesses. When a company like Coinbase signs up a new customer who wants to buy Bitcoin with US dollars, Coinbase places those dollars on deposit with Silvergate, which has that cash in reserve. When customers later decide to cash in their Bitcoin and take back their dollars, Coinbase asks Silvergate for the dollars and passes them on to the customers. Silvergate has been working with big corporate players in the crypto world, offering crypto and real-world US dollar deposits. In 2019, Silvergate listed on the New York Stock Exchange, selling its shares in an initial public offering at $12 each, valuing the business at around $230 million. However, the events of the last 12 months in the crypto markets have had a detrimental impact on Silvergate's value and viability. In Q4 of 2022, the company made a net loss of $1 billion, compared to a profit of $18 million in the previous quarter. Customers withdrew over $15 billion from Silvergate accounts in the 3 months ending December 2022, representing more than 50% of its total assets. As a result, Silvergate's interest-bearing deposits decreased by 52% to $6.3 billion, and non-interest-bearing deposits fell by 61% to $3.9 billion. The reason for Silvergate's monumental loss is that it had been putting all of the cash that had been given by its corporate customers into federal bonds to make a return on that capital. However, over the last 12 months, interest rates have increased, causing the price of bonds to fall. Since all of these customers are now demanding their money back, Silvergate's bond portfolio has significantly decreased in value, resulting in significant losses for the bank. Silvergate Bank was a key player in the world of cryptocurrency. It helped businesses like Coinbase and Galaxy Digital store their real-world dollars while also offering crypto deposits. However, the crypto market's recent volatility has had a detrimental impact on the bank's viability. In December 2022, customers withdrew over $15 billion from Silvergate accounts, which represented more than 50% of its total assets. As a result, Silvergate posted a net loss of $1 billion in the quarter ending December 2022, compared to a profit of $18 million in the previous quarter. So, what went wrong? Silvergate wanted to make a return on the capital it had received from its corporate customers. Instead of just holding the cash, it invested in US government bonds. However, the bank encountered a problem, a material increase in interest rates. When interest rates go up, bond prices go down. Therefore, Silvergate had to sell its bonds in the market to get the cash back, resulting in huge losses. To maintain a highly liquid balance sheet, Silvergate sold $5.2 billion of debt securities for cash proceeds during the fourth quarter of 2022. Unfortunately, this sale resulted in a loss of $751 million in the quarter. Additionally, the company recorded a $134.5 million impairment charge related to an estimated $1.7 billion of securities it expects to sell in the first quarter of 2023 to reduce its borrowings. As a direct result of its financial difficulties, Silvergate decided to discontinue its Silvergate Exchange Network, the 24/7 payment system offered to all of its corporate customers. This decision caused a ripple effect, with many cryptocurrency businesses dropping Silvergate as their banking partner. In response to this, Silvergate Capital announced its intention to wind down operations and voluntarily liquidate the bank in an orderly manner, in accordance with applicable regulatory processes. Silvergate's wind down and liquidation plan includes full repayments of all deposits, and the company is also considering how best to resolve claims and preserve the residual value of its assets, including its proprietary technology and tax assets. However, this announcement is catastrophic news for investors in Silvergate Bank, as well as the crypto markets in general. The failure of Silvergate will not only cause problems for other companies but also raise concerns about contagion and confidence in the financial markets. In the world of cryptocurrency, confidence is critical, and when a bank like Silvergate goes into liquidation, it can shake investors' faith in the entire market. The fear of crypto imploding can lead to further withdrawals, and this was a key factor in Silvergate's failure. Investors wanted their dollars back, and this forced the bank to sell its bonds at a loss, resulting in over $1 billion lost in Q4 of 2022. Unfortunately, the failure of Silvergate is likely to trigger even more withdrawals, which could spell trouble for other crypto businesses over the next 3 to 6 months. In summary, the failure of two specialist banks based in the USA within a few days of each other is significant news. Silicon Valley Bank catered to early-stage venture capital companies, and Silvergate Bank serviced corporate clients in the cryptocurrency market. Both banks shared similar characteristics in that they had a large amount of cash deposited, which they struggled to invest profitably due to historically low interest rates. This situation is a problem for a bank as it needs to earn a return on the money to make a profit above the interest paid to depositors. The overall message is that the failure of these banks should serve as a warning that there may be bigger problems in the wider financial sector. The interconnectivity of financial markets means that the failure of one institution can have a ripple effect on others. It is a challenging time for the banking sector, and investors need to be mindful of the risks and carefully consider their investment decisions. In the world of crypto, confidence is crucial, and recent news of Silvergate Bank's liquidation has sparked concerns that cryptocurrency is collapsing. The failure of Silvergate Bank can be attributed to investors wanting to withdraw their money from cryptocurrency, causing a ripple effect that ultimately led to Silvergate's loss of over $1 billion in Q4 2022. This event is likely to cause further withdrawals and may spell trouble for other crypto businesses in the coming months. However, the problem of too much cash and a lack of investment opportunities is not unique to Silvergate Bank. Silicon Valley Bank also faced this issue and turned to long-term bond markets in search of higher yields. Unfortunately, the rise in interest rates over the past year has caused these bonds to decrease in value, leaving both banks with significant losses. While the closure of Silvergate Bank is big news, the larger concern is whether other financial institutions around the world are facing similar challenges. It's highly probable that other banks and institutions are holding onto portfolios of investments that are out of the money, and if they are forced to cash those in, it would result in crystallized losses. The banking and financial sector is built on trust, and a lack of it can cause a run on the bank. If people start to lose faith in their financial institutions and withdraw their money, others are likely to follow suit, causing a contagious run that can quickly deplete the bank's cash reserves. It's important to note that while there are protection schemes in place to safeguard individual deposits, larger deposits from corporate clients may not be fully protected. This is what has happened with Silvergate and Silicon Valley Bank, as their corporate clients became concerned about the lack of liquidity and withdrew their large deposits. This situation is reminiscent of what happened with Bear Stearns and Lehman Brothers at the start of the 2008 global financial crisis, where problems that were initially specific to those two banks quickly spread throughout the financial sector and triggered a major crisis. While the current situation with Silvergate and Silicon Valley Bank appears to be contained to those two banks for now, there is a risk of contagion and a potential domino effect if other banks are also facing similar problems. It is important for regulators and policymakers to closely monitor the situation and take appropriate action to prevent any further fallout. It's important to remember that the financial sector is based on trust and confidence, and any loss of that trust can lead to devastating consequences. It's important for financial institutions to properly manage their investments and liquidity, and for regulators to monitor and enforce regulations to prevent systemic risks. As always, it's important for individuals and companies to be aware of the risks associated with their investments and to make informed decisions based on their own financial goals and risk tolerance. The conclusion. The recent failures of Silicon Valley Bank and Silvergate Bank serve as a warning sign for the entire banking and financial sector. The search for yield in a low interest rate environment has led many institutions to invest in riskier assets, and now that interest rates are rising, these assets are losing value. While there are protection schemes in place for depositors, larger corporate clients may not be fully covered and could face significant losses. The possibility of contagion and a domino effect cannot be ruled out. It is crucial for banks and financial institutions to carefully manage their investments and maintain adequate levels of liquidity to avoid potential crises. As always, trust is a fundamental aspect of the financial system, and any loss of confidence could have severe consequences. Thank you for watching, and please stay tuned for future updates on this developing story. Thank you for watching the video to the end. If you like the video, don't forget to subscribe our channel to watch the upcoming outstanding videos.